Singapore, a global hub where goods, people, and capital flow seamlessly. The logistics and transportation sector is the lifeblood of this city-state's economy. But what does 2025 hold for this critical industry? After a surprisingly strong start to the year, the second half of 2025 presents a more complex picture. Trade tensions and economic uncertainty are creating headwinds, yet powerful long-term trends like the e-commerce explosion and massive government investment in infrastructure are creating incredible opportunities. Today, we're diving deep to analyze the top 3 Singaporean mid-cap logistics and transportation stocks to watch in 2025. We'll break down their strategies, financials, and what could drive their performance in the year ahead. Before we proceed, it's important to state the following. This video is for educational purposes only. It is not financial advice and should not be taken as a recommendation to buy or sell any security. Please do your own research or consult a licensed financial advisor before making investment decisions. So, what's the big picture for Singapore's logistics sector in 2025? The first half of the year saw impressive growth, with the transportation and storage sector expanding by 4.4% in the second quarter. However, this was largely driven by companies front-loading shipments to get ahead of new U.S. tariffs. This means we can expect a slowdown in the second half of the year as this temporary boost fades. Despite this, the long-term outlook is shaped by powerful forces. First, the e-commerce revolution. While the overall logistics market is growing at a steady 4%, Singapore's e-commerce market is set to explode at an 11% compound annual growth rate through 2030. This creates huge demand for last-mile delivery and specialized logistics. Second, government investment is a massive tailwind. Singapore continues to be the world's top shipping hub, and the ongoing expansion of Tuas Port will add thousands of jobs and significant capacity. The government is also pushing for the adoption of AI, IoT, and blockchain to make supply chains smarter and more efficient. Finally, global trade is shifting. Companies are moving away from a sole focus on cost and are now prioritizing supply chain resilience. This nearshoring trend benefits strategic hubs like Singapore as trade within the Asia-Pacific region intensifies. Within this dynamic environment, 3 mid-cap companies stand out. Let's take a closer look. SATS is a global leader in aviation services, providing everything from ground handling and air cargo to in-flight catering. After its major acquisition of Worldwide Flight Services, or WFS, SATS now operates in over 215 locations across 27 countries. Financially, the company has seen a strong recovery. Full-year 2025 revenue hit 5.8 billion Singapore dollars, and the integration of WFS is already delivering significant cost savings. The key growth driver is leveraging its newly expanded global network to win new contracts, all while benefiting from the continued recovery in air travel. However, the main risk for SATS is its exposure to the global economy. A major slowdown or escalating trade tensions could directly impact air cargo and passenger volumes. Next, we have ComfortDelGro Corporation. ComfortDelGro is a land transport giant known for its bus, rail, and taxi services. While a familiar name in Singapore, the company has made a strategic pivot to the global stage. For the first time ever, over 50% of its revenue now comes from overseas, thanks to major acquisitions in the UK and Australia. This diversification is a game changer, reducing its reliance on the competitive Singaporean market. Financially, the company is on solid ground, with revenue and net profit both climbing in the first half of 2025. Its balance sheet is strong, with low debt levels. Growth will be driven by these international acquisitions and new public transport contracts, like its new bus franchises in Manchester. The key risks remain at home, with intense competition in the taxi market and the potential loss of local bus contracts. Higher interest costs from its acquisition financing could pressure profits. And finally, our third company, Singapore Post. Singapore Post, or SingPost, is a company in the middle of a high-stakes transformation. The goal? To shift from a legacy postal service into a pure-play e-commerce logistics enterprise. The company's recent financials need a closer look. While it reported a large net profit of $245 million, this was due to a significant one-off gain from selling an asset. Its core business actually saw a 40% decline in underlying profit, even recording a small net loss in the second half of the fiscal year. The investment case here is a turnaround story. The company is investing $30 million in a new automation system to triple its parcel handling capacity and position itself as a regional e-commerce hub. This brings us to the primary risk: execution. The success of Singapore Post hinges entirely on its ability to execute this difficult transformation and return its core logistics business to profitability. So, how do these companies stack up? SATS trades at a premium valuation compared to its peers. This reflects strong investor confidence in its global leadership and clear earnings visibility following the WFS acquisition. ComfortDelGro's valuation is more conservative. This suggests the market may not have fully priced in the benefits of its successful international expansion. Singapore Post trades at a significant discount to its asset value, as shown by its price-to-book ratio of 0.76. This discount highlights deep investor skepticism about its turnaround plan. When large institutional investors analyze these stocks, they look at several key factors. First, earnings visibility and scalability. SATS and ComfortDelGro are strong here, with long-term contracts providing predictable revenue. Singapore Post's visibility is low due to its ongoing restructuring. Second, leverage. ComfortDelGro has a very strong balance sheet with low debt. SATS is focused on paying down debt after its big acquisition, which is a positive sign. Singapore is in a net cash position, but this is due to asset sales, not operational profit. And third, ESG practices. All three companies are focused on sustainability. SATS has a target to cut carbon emissions by 50% by 2030. ComfortDelGro is rated as a low ESG risk, while Singapore Post is rated as medium. To wrap up, 2025 is a year of transition for Singapore's logistics and transportation sector. We have SATS, a newly crowned global leader with strong momentum but remains tied to the health of the global economy. We have ComfortDelGro, a company that has successfully de-risked its business through international diversification, offering a more stable growth profile. And we have Singapore Post, a high-risk, high-reward turnaround play where success depends entirely on executing a difficult strategic shift. While the broader economic outlook has its challenges, the underlying trends of e-commerce, infrastructure investment, and supply chain realignment present clear opportunities. These are certainly three fascinating companies to watch in the dynamic Singapore market of 2025. Thanks for watching. Remember to do your own research, and we'll see you next time.